Most people still think GE is a dying brand. That's the mistake. They picture a bloated industrial mess, power plants, light bulbs, appliances, but that company doesn't even exist anymore. It was stripped for parts. What's left is GE Aerospace, and it might be one of the most profitable aviation businesses on the planet. They don't just build jet engines, they dominate the entire life cycle. One sale locks in 20 years of recurring cash flow. They already power 3 out of every 4 commercial flights, and almost nobody watching this knows that. GE Aerospace just pulled off a monster quarter. Revenue up, cash up, margins expanding. The market didn't take notice. That's the moment I watch for, when a great business gets overlooked by people who think they've already figured it out. This isn't hype, it's not a guess, it's just math. And once I saw it in the numbers, I acted. Most people hear GE and they instantly tune out. They think broken company, failed turnaround, slow death. But GE Aerospace isn't a relic, it's a monster, and it's only getting stronger. This isn't the GE that sold refrigerators and ran bloated power plants. That version got gutted. GE Healthcare is already spun off. GE Vernova is next. What's left is the crown jewel, a pure-play aviation and defense engine. They don't make planes, they power them. GE Aerospace builds the jet engines that drive commercial airlines and military aircraft around the world. But more importantly, and this is what most people miss, they don't make money selling engines. They make money keeping them alive. Every sale locks in decades of high-margin service contracts. It's the razor and blade model, scaled globally. Right now, GE engines power around 75% of all commercial flights. Let that sink in. Every time you fly, there's a 3 in 4 chance GE Aerospace is getting paid. And that's not just once, it's recurring, long-term, and built into how airlines operate. This business doesn't depend on hype, it depends on time. The longer these planes stay in the air, the more money GE makes. And they just secured long-term deals with Korean Air, Cathay Pacific, and U.S. military, stacking billions onto a backlog that already sits near $175 billion. This isn't a turnaround story. It's a cash flow machine hiding inside a company name you thought you understood. And that misunderstanding is exactly why the opportunity exists. When a company is built right, the numbers tell the story. No fluff, no excuses, just output. And GE Aerospace just posted one of the cleanest quarters I've seen this year. Revenue up 26% year over year. Profit up 33%. Earnings per share up 44%. Free cash flow $2.4 billion, up 30% from last year. They raised full-year guidance across revenue, EPS, cash flow, and profit. This isn't a company that beat by a penny and lowered guidance. This is a company accelerating on every metric that matters, and the market barely reacted. That's the disconnect. Let's break it down. Commercial engines up 40%. Defense deliveries up 83%. Commercial services, which is where the real money comes from, grew 28%. They're building, delivering, and servicing more engines than ever, and the margin profile is scaling with it. Operating profit, $2.3 billion. Full-year EPS now expected to land between $6 and $6.20. Free cash flow on track to exceed $7.3 billion. And that's without any stretch targets. The takeaway is simple. GE Aerospace isn't trying to tell a turnaround story. They're just printing results. Quietly, consistently. And the longer it takes people to realize that, the bigger the opportunity becomes. The moat is massive and getting stronger. Most companies sell a product once and hope the customer comes back. GE Aerospace doesn't have that problem. They sell you an engine and get paid for the next 20 years to keep it running. That's not a business, that's a cash printer. There are roughly 70,000 GE engines flying around the world today. That's not a stat, that's a locked-in customer base because airlines don't rip out engines every few years. They pick a provider and stick with it for decades. GE Aerospace powers 75% of global commercial flights. That gives them something most companies will never have: scale, switching costs, and recurring revenue baked directly into the product. The real money isn't in selling the engine, it's in the servicing. That's where the margin lives. Airlines don't want breakdowns, they want uptime. So they pay GE to run diagnostics, replace parts, monitor engine health, and deliver predictive maintenance before something goes wrong. And now with AI-powered tools and digital twins, GE is locking in even more margin by solving problems before they show up. They even partnered with Microsoft and AWS to build cloud-based engine analytics. Why? Because every hour of flight time is a data stream, and GE owns the data. This isn't just a wide moat, it's a walled fortress. Switching costs, technical advantage, installed base, recurring revenue, the kind of setup that protects cash flow even when the economy gets hit. Most companies are fighting for their next customer. GE Aerospace already has theirs, 20 years out. Now let's go over the real bull versus the bear case. Most people either blindly believe in a stock or blindly hate it. That's how they lose. Just look at Tesla. People are either in love with it or trying to kill it. I care about the math, the cash, the edge, and the risk. GE Aerospace has a lot going for it, but if you're not willing to look at the full picture, you don't belong in the stock. Here's the bull case. This is a wide moat compounding cash flow engine with built-in demand from both commercial and defense. Their engine backlog just hit $175 billion. That's future revenue already sold. Now they just have to deliver in service. Free cash flow is rising every quarter and the business is vertically integrated. That means control, efficiency, and margin. They're scaling digital services, which improves reliability and adds high-margin software revenue on top of the hardware. The stock is up over 80% year to date and hasn't blown out yet. That tells you institutions are quietly loading. Have you flown lately? Flights are packed. Airlines can't afford downtime. GE keeps those planes in the air. Every hour grounded costs money. Every hour flying prints it. Now the bear case. You're paying a premium. The forward PE is around 50. That's rich, even for a high-margin business. Defense orders were down this quarter. Some of that is timing, but if those delays stretch, revenue growth could soften. Growth from digital services is early. If adoption is slower than expected, margin upside may not materialize as fast. This is not a startup. The days of 50% revenue growth are gone. This is a compounder, not a rocket. The bottom line, this is a high-quality machine, not a meme. The risk isn't that it fails. The risk is that you overpay and lose patience before the story plays out. If you want a fast return, this isn't your investment. If you want consistent output over time with a durable moat behind it, GE Aerospace delivers a real look. What I'm doing right now and why I just bought GE Aerospace. I didn't buy GE because it's cheap. I bought it because the quarter was strong, the setup was clean, and the risk reward was impressive. That's what I wait for. On Friday, I sent out a trade alert when I bought GE, not because I'm guessing, because it showed up on my brand new post-earnings hot stock list, and that list is fire. It filters for high-quality businesses with monster quarters, clean technicals, and post-earnings bullishness. GE popped, I was ready. This wasn't a buy-the-dip play. It wasn't a hype spike. It was a slow, steady post-earnings grind into a momentum squeeze, backed by expanding margins and rising free cash flow. The kind of setup I absolutely love. The kind most people overlook until it's already gone. And let's be clear, sometimes I do buy when a stock's already running. That's called momentum. But this wasn't that. This is a momentum squeeze with a bullish thesis, and I expect the stock to go higher, especially long term. GE Aerospace is a cash-rich, contract-loaded, wide-moat compounder with leverage to defense, commercial travel, and digital services. This isn't a bet on what could happen. It's a position built on what's already happening in the earnings report. This isn't super sexy. It's serious. But here's the truth. It's the girl next door kind of beauty, the one nobody notices until it's too late. And yes, it gets a little sexy when you understand the math. So here's the real question. Is this business getting stronger every quarter? Check. Are the numbers trending up across revenue, customers, contracts, and cash flow? Yes. Is the product becoming harder to compete with? Absolutely. And is there a wide moat protecting it all? No question. That's the edge. That's what you bet on. I'm long, and I'm looking to add to this position. So let me ask you something. Who else is showing you how to actually trade earnings momentum in real time with a strategy built around data, risk control, and execution? Who's breaking down GE Aerospace with no hype, no noise, and showing you why a boring jet business might be the best stock nobody's watching? Nobody. That's why GE is on my radar, and it's why so many people inside my Patreon are banking gains while others are still chasing headlines. Wreaks Havoc just closed $11,528 on IREN and said it paid for a lifetime of my Patreon. Dan, he's up 43% year to date after joining in May. To the Moon, they pulled in $5,208 off QBTX and called it a ride. Meanwhile, my own portfolio up over $2.5 million this year and 73% year to date. This isn't theory. This is what disciplined, repeatable execution looks like. Inside my Patreon, you get real-time trade alerts with full breakdowns, the exact setups I'm taking, daily market analysis that cuts the fluff and shows you what matters, and my momentum strategy with step-by-step guidance, and the most dialed-in investment community I've ever seen. It's only $30 a month, and that's nothing when you see what it's doing for others. Instead of blowing $30 on bullshit, put $30 into something that could actually make you better. And if you don't 3x your investment in yourself, cancel it. It's as simple as that. You can scroll or you can scale, but don't say you weren't told.